Before we get going today, I want to just make a special little announcement. It's December 7th, 2017, and I wanted to let you know about the information being made available to us for the net neutrality vote that's coming up. For those of you that are not familiar with the net neutrality vote, it affects everyone in the United States in regards to how ISPs can deliver content to us, whether they can throttle it, whether they can block it, and of course, we don't want that. So the good folks over at Joom Connect, Chris Chase and his team, have created some content that we can all use to inform our users about the problem and encourage them to act and call Congress or make their voices known with their representatives. It contains 2 blog posts, some social media posts, ads, and instructions for running a script on your website that can actually put people right in touch with their local representatives. You can download the campaign, everything you need, free of charge at www.joomconnect.com/net-neutrality. I'll also put a link on the IT Provider Network, maybe a little easier to remember, itprovidernetwork.com/NN. That'll take you right to Joom Connect. So thanks to Chris Chase and the folks over at Joom Connect for doing that. We used it in our own ISP, and we're making our users aware of the problem and encouraging them to take action. It's that time of year. We all have less than 1 month left to wrap it all up. In today's episode of the IT Provider Network podcast, I want to walk you through some of the things we do to plan for the upcoming year.
Welcome to the IT Provider Network. Are you a managed service entrepreneur wanting to take your business to the next level? Do you excel in IT but feel your business management could be better? Join Terry Rossi, where every episode he shares the skills, tips, and tricks that helped him to build a successful worldwide business.
December is always a crazy month for us. We're what they call a subchapter S corporation in the United States, and that's a type of tax structure that requires your corporate year end to be the same as the calendar year end. So most small businesses that are subchapter S's, and I believe the limited liability corporations have to end on the end of the year as well, they're scrambling in December. They're trying to wrap everything up, get their financials in order, minimize their tax position, and let me tell you, we're no exception. What I want to share with you today is a high-level overview of what we do to close out the year and plan for the upcoming year. This consists of really 3 main tasks. We got to clean up our financials, get our books in order for the end of the year. We need to reflect on what we've done during the year to help us plan as we go forward. And then we need to plan for the following year and base those plans on the lessons we've learned and the growth we want to achieve. So that's what I want to talk to you about. Let's get right into the financial work we need to do at the end of the year. January comes with or without you being ready, and just like life, there's really not a lot of do-overs. So you need to make sure you have pretty much everything in line in your business before the end of the calendar year. So some of the financial things you should take care of, and before I say this, let it be written and let it be said. I'm not a financial advisor, but I have been doing this for 22 years, so I know some of the things that we do, and that's what I'm going to share with you today. The first thing is if you're an owner and you're also a W-2 employee, which I am, so I own the company with my business partner, but I'm also on payroll. I get a check like everyone else. You need to make sure that you've satisfied what the IRS calls your safe harbor requirements. And that means that you need to make sure that you have either made estimated tax payments to cover your income or that you have significant withholdings to be able to cover your income for the year. If your business is doing well and you're increasing your income every year, maybe you're taking some disbursements, you always want to make sure that you have your tax safe harbor met before the end of the year. So what this does is it ensures you don't get any penalties. So do that. If you have a retirement plan, like a 401k or some kind of IRA, some kind of retirement plan, make sure you're taking full advantage of that. You know, there's tax savings there. If you're over 50, like at least one of us here is, you can even do what they call catch-up contributions. So catch-up contributions allow you to add more into your savings plan at the end of the year. Savings plan every year after you're 50, so you can bank on some more retirement money. Today, that means you can put an extra $6,000 in there. So that's a really nice advantage if you have extra cash at the end of the year and you can sock it away in your retirement plan. If your company was lucky enough to have a profitable year, you need to look at your tax liability. You need to see what you can do to minimize your exposure. Talk to your accountant about this, but I got to tell you, usually they're not a lot of help. They give you some basic advice, but they won't give you some really brass knuckle tactics. A common strategy here is to get your bank account down as low as possible before the end of the year. This is typically if you're on, I believe, the cash accounting basis. So if you're reporting on the cash basis, then you want as little cash as possible. This is sometimes a double-edged sword. I know one time we had some loan covenants that we needed to meet that required us to have some cash in the bank. You also might need cash to actually run your business come January 1st. Maybe you're banking on sales that are going to happen that maybe don't happen. So the bottom line is you're going to have to pay some tax, at least most people are. Don't put yourself in a situation where you're jeopardizing your business to save taxes. One thing you also should know is paying yourself a bonus, taking a distribution, repaying a loan, paying down your credit card balances or your credit line balances. They don't change your tax structure. They simply move money around in your company that belongs to your company. So if you're going to spend money at the end of the year, you need to be spending it on actual expenses, stuff you're buying, stuff you're spending money on at the end of the year. We usually buy cars at the end of the year. Whatever we can do to minimize tax expenses, providing we actually need what we're buying. We don't buy stuff just to buy it. Remember, when you buy stuff just to buy it to save taxes, you're spending $1 to save 40 cents. You're still spending $1, so don't forget that. The second thing you want to do is go through your income statement. And you really want to analyze what I call the goes indas and the goes outas. You really want to see where you're making money in your company and where you're not. See where the holes in the bucket are, where you're spending cash. Remember that old saying, revenue is vanity, profit is sanity, and cash flow is king. You need profit and cash flow to make your business survive. Revenue, the top line revenue number, while it helps you get everything else in order, it's really just bragging rights. The bottom line is what you take home at the end of the year and how much cash you have to pay your bills, your employees, keep your business sane. When you're looking at your income statement, you really need to analyze things that you're selling that you may not be making any money from. I want to talk about a quote that Paul Dipple just gave me. Paul is one of the owners of Service Leadership. They're an outstanding consulting organization that's involved in the MSP space. If you haven't heard of Service Leadership, I suggest you go check them out at service-leadership.com. And I asked Paul about a quote that I heard him say at IT Nation. And the quote was talking about selling hardware and software at a particular markup. And if the markup wasn't enough, you were essentially selling it at zero profit. So most people are lucky to get 20 points on a piece of hardware, 25 maybe if they're lucky. But in reality, what Paul says is if you're a service organization, well, let me read you exactly what he says. Here's what Paul says. Per the Service Leadership Index, and that's a benchmark study that they do in the MSP community, the median profitability for service-centric firms like MSPs spend about 30% of their revenue on sales, general and administration or SG&A, and overhead. Therefore, anything sold with a gross margin less than 30% is in and by itself losing money at the bottom line. But it's not quite that simple. And Paul goes on to say, median profitability, it's not quite that simple. And Paul goes on to say, simple enough. However, as you know from running your own firm, you don't pay bills with gross margin percentage. You pay bills with gross margin dollars. So let's say you have $500,000 in SG&A to pay out, but you only have $350,000 in gross margin dollars from your services to cover that nut. Luckily, you might have $200,000 in gross margin dollars from selling $2 million of product at 10% margin. You combine the $350 from services with the $150 of margin from product resale, and you're able to pay your $500K in SG&A. You still have $50K left over as bottom line profit. So selling these products at a lower margin, while theoretically is not making money in itself, can help you get through the day and make your firm profitable. So I paraphrased a little of that, Paul. I hope you give me poetic license with that, but thank you for answering my question. Paul Dipple from Service Leadership. I encourage you, if you're not working with Service Leadership or you don't have their sleek product, or you're not participating in the Service Leadership Index, I suggest you do that. It's really, really a great way to understand where you are in the community and how well your company is doing on what they call operational maturity levels. So check out Paul Dipple and the Service Leadership Group at service-leadership.com. So after you go through your revenue statement, you're finding out where you're spending money, where you're making money. You want to look at all your recurring charges, all the products and services that you buy on a monthly fee, and see if you're actually using them in your business. Oftentimes you'll find that you have services that you've subscribed to that you're not really using. So the end of the year is a good time to either pre-buy for the next year if you have a profitable year and you want to, generate some expense, or cancel them if you're not getting any value for it. So look at your recurring charges. The next thing you want to think about is gifts for your customers or employees. You really want these ready to go by the second week of December. So right about now, you want to have them ready to roll. I know we're often scrambling to get something out before the holiday week. This is something we don't do a great job of. We're always kind of scrambling to get the gifts together, get them out to the customers. So you want to try to avoid that added stress and plan early. If gifts aren't in the budget, or if it's just not your thing, then at least send out a card. I usually have everyone in the office sign a holiday card and send it out to our customers. It's a really nice touch. They like to see people's names, and our customers like to get the card. So we do that every year. Most years we send out a gift. If we don't have our act together, then sometimes we might send it out in New Year's or even Thanksgiving. Bonuses. So obviously the end of the year is when you would look at an end of the year or Christmas bonus. If you're giving a holiday bonus out, you want to make sure it corresponds with your end of the year planning. And if possible, you want to get it into your employees' hands before Christmas. Different companies have different opinions on the so-called Christmas bonus. I personally think it spreads goodwill, but like with everything with compensation, it can get complicated. How much do you give? How much did you give last year? Do you give more to the senior people? Do you give more to the more tenured people? These are all tough questions, and really questions that you guys need to figure out for yourself. You need to navigate it for yourself. You need to figure out what you want to do. And if cash is tight, you can't give a bonus. There's other ways to show some appreciation for your staff too. Maybe you have them over for dinner, or you take them out to eat. If nothing else, you can always give them a day off without pay, although this is often way more expensive than giving a bonus. So those are some of the things you want to think about on the financial side come end of year. I'm sure it's not a comprehensive list, but it's definitely some of the things that I've been working on this month. The next thing you want to do is reflect on your accomplishments and maybe even your failures. So now you have your finances in order. You've done your best to so-called cook the books for the tax man. Now it's time to look back on the year and see what you've done well and maybe not so well. You should also think about what's happening in your industry as well as what's happening in your clients' markets. How is that going to affect your business going forward? How are changes in the MSP industry going to affect you? How are changes in your largest customers going to affect you? Maybe good, maybe not so good. We're in an ever-changing market, and some in our space predict that doom is right around the corner. I know Ingram Micro's president, Paul Bay, at their conference last week just kind of shocked the crowd. He said there was a third-party study that basically predicted that 70% of the MSPs and resellers won't make it through what they're calling the digital disruption. So we need to really move and shake. We need to reinvest in ourselves. We need to reinvent ourselves for the world that's changing around us. The end of the year is a perfect time to reflect on this and kind of really think through the way you're going to move next year. So I talked about tearing apart your income statement. Make sure you're looking at what you're selling. Everything you sell, sort it from most profitable to least profitable, and make some hard choices. You either need to figure out how to make it profitable or dump it. There's levers that you can use to get more cash and sometimes and most times more profit into the company. So you want to be thinking about them. These levers that I'm going to talk to you about all come from the book Scaling Up, and I'll talk about scaling up in a minute, but you can increase the price. So this one's easy. If you can charge more, you can charge more, and then you can therefore make more. You can increase the volume. So sometimes just moving more of one product can help your company, either by bringing in more cash or better utilizing your service resources that are trained in that product. So increase the volume. Reduce the cost of goods sold. So that's always an option. You can always comparison shop, try to reduce the cost of the products and services that you're delivering. Reduce the AR. This doesn't help you make more profit, but it definitely helps you get more cash in the door. Get your money from your clients faster. Make some calls, collect some debts. Don't let customers get sloppy and late on their payments. Reduce your stock days. Now, this one doesn't really apply to most of us. I hope you're not keeping stock. We don't keep stock on anything, really. We can get almost anything we need in a day, and if we really need it fast, we can drive to the distributor and get it. Hopefully, you have that luxury as well. Sixth thing you can do is increase your credit days. So a lot of times HP, Cisco, and other large vendors, Lenovo, they'll give you extended terms for registered deals. Use this cash in the extra days to your advantage. Talk to your distributors. I know if I have a large deal, I almost always try to negotiate net 45 terms, and I get better pricing. So do that. Extend your pricing if you can. If you can't do any of that because maybe you don't have large deals, then you can always slow down the payments a little to your distributors. Not a lot, but just a little if you need some cash to make payroll or something else that's going on in your company. So Vern Harnish, the author of Scaling Up, and that's the book I talked about, he talks about the power of one with these levers. And what he's basically saying is a 1% change in all of them make a tremendous change in your business. So if you haven't read the book, I suggest you get it right away and start putting the principles of scaling up to work in your business. We run our entire company based on those basically the four principles in the book, which are concentrating on people, execution, strategy, and cash. It's made a huge difference for us. We're putting 25% plus to the bottom line this year. Nothing wrong with that, guys. After you've looked at your financial successes or maybe some of your failures from last year, look at some of the less tangible things. Get your team together and ask yourself some questions. What lessons did you learn this year? What did you do really well? What occurred this year that you're really grateful for? And these might be sales-related things, service delivery related things, or they might be just great things you did with your team, or maybe something you did in your building. What did you do really well this year? Maybe these are projects, onboardings, good hires, good meetings. Think about those things, reflect on those things, document those things so that you have a record of what you did. Think about the clients that you landed this year. What can you do to get more of those clients? Hopefully they're good clients. They're in the right market. They have the money to spend. They're doing business with you and having a good time. Think about how you can get more of them. What did you do to land those clients that are your best clients, and how do you get more of them? On the flip side, think about your churn. If you've lost any clients, what could you have done to maybe prevent that? What happened that caused you to lose your clients? One of the things that I'm going to concentrate on this year is marketing and communications. And I think one of the reasons we churn clients out is because we're not communicating with them well in a way that facilitates them remaining customers. Sure, we have help desk conversations with them, but that's it. So think about all those things. Also think about what's happening in your clients' industries. And I talked about this a little earlier in the show. But what's going on in their industries that's going to affect your business, either good or bad? And if it's bad, find maybe some things that are good in that industry or other industries that can help you build and grow your business. So now take a little time and let all this settle in. This is what I do. I take about a week or so and I let all this kind of settle in and I look at it, I study it. I keep on my team to keep them coming up with forecast targets, ideas, methods that we can use to achieve our goals. Because remember, with a goal without a plan is just a wish. So if you don't have a plan, if you don't have it written down, you just have a wish. So your team needs to be working on creating a plan for the next year. And I encourage you to try this. When you wake up in the morning, ask yourself this question: what can I do to explode my business next year? And if you don't like the word explode, substitute some other positive word in there, but make it big. What can you really do to make your business take off next year? Ask yourself this question first thing in the morning and make sure you frame the question in a positive way. Write down some answers. They might seem silly, but maybe that's something that you can take and run with in the following year. So the next thing you want to do is build your plan. So after you've let that data cook in your head for a while, you've gotten your team together, you want to come up with some metrics and plans for the upcoming year. In our process, we have 5 to 6 key performance indicators or metrics that we use and 3 to 5 key initiatives that we want to achieve during the year. Each one of our metrics has a forecasted value, along with values for being below target and above target. So we kind of have goalposts that we put around our forecast that says, here's where we are. As the year progresses, we use these values to see how well we're doing against the goal. The initiatives are statements. They're pretty much just statements that we make at year end, things we want to accomplish during the next year. Like the metrics or the KPIs, every initiative has to have an owner. So both the metrics and the initiatives all have an owner, and the owner is responsible for really fleshing out the initiative, making sure it gets properly scoped, and moving it towards completion. I'll give you an example. For next year, I have 2 metrics and 1 initiative that I'm responsible for spearheading. The metrics are around new clients. The 2 metrics are new clients and total clients. Now, we define a client as an entity that's been invoiced by us in the last 13 months. We use 13 months so we can deal with customers that are only invoiced annually. And we determine the values we're shooting for in the upcoming year by looking at our customer acquisition rate and our churn rate. So for next year, we tried to increase the acquisition rate, obviously, and decrease the churn rate. So our metrics for new clients and total clients were based on this year's achievement plus a factor of so much percent. That's how we get the green target or the forecasted value for the metric. Then we set our below average and above average, or below target and above target numbers to some reasonable distance away from that green target. So let's say the green target was 10 new customers. The below average goalpost might be 7, and the above average goalpost might be 13. So we call those red, green, and super green. Most of our metrics pertain to sales and finance. In my opinion, this is the heart of any business and deserves the most attention. So without revenue and cash, you really have nothing, right? As techies, we often gravitate to the technical stuff, but to be an entrepreneur, you really need to focus on sales and profit. So those are my 2 metrics, new clients and total clients. My initiative, which is a pretty big one, is stated as follows: become better as a company when communicating with our customers, employees, and prospects. Execute a marketing plan. Make decisions on what to invest in going forward. This is a mouthful and really was a combination of 2 initiatives: better communication in everything we do and executing a marketing plan. So that reminds me, you really need to think about another thing when creating your initiatives. Less is more. You need to make tough choices. Not everything you want to be done can realistically get done in a year. So you and your team need to cut and prioritize so that you have the most important 4 or 5 initiatives in the plan. Now, 4 or 5 are just what we do. If you have a larger company, maybe it's 7 or 8. If you have a smaller company, maybe it's 1 or 2. The bottom line is don't bite off more than you can chew. You want to be successful in your plan. You want to move the company forward. You don't want everybody being in the red all year and being behind. So that's the bulk of how we plan. There's some important things you want to remember to be successful in this. Everything you're going to monitor, measure, and improve on needs an owner. That person is responsible for moving the initiative forward and creating smaller initiatives. We call them goals or rocks that you make during the quarter that'll move the company forward and help you achieve your goals. That owner is not necessarily responsible for achieving the goal, just moving it forward and keeping it alive in the organization. The second thing you want to remember is the plan needs to be written down, preferably in a way that the management team can collaborate on it, right? You want to meet regularly about the plan. You want to go over the metrics. You want to collaborate on the plan and adjust if necessary. Don't go crazy on the formatting of the doc or the technical details. Just get a simple spreadsheet up, maybe in Google Sheets or Office 365. That'll work just fine. Just some way that everyone can look at it and maybe possibly edit it. The third thing you want to remember for success is that the plan needs to be nurtured and worked. Start out the year by putting set meetings on your calendar and make strategic planning a priority. So that's about it for episode 25 of the IT Provider Network. I hope you've enjoyed this. I hope you're planning for 2018, and I hope you had a great 2017. I'm not sure if we're going to talk before the holidays, but I wish everyone a happy holiday, and I hope you have a safe time and a good time with your families. I want to thank everyone that again signed up for Coinbase. This week, we got 4 or 5 different people that signed up. I want to thank you for going to Amazon and clicking on my affiliate link. And I want to thank you for listening and subscribing to the podcast. It's really important to me that we continue to build this audience. So please consider subscribing if you're not a subscriber. Also share the episode with your friends and try to build some audience for me. I would appreciate it. Connect with me on the socials. Check out the website. Check it all out. I'm giving you 100 calls to action today. This is absolutely the wrong thing to do, but please do them all. Have a great day. Remember, we are IT.
Thank you for joining us, and we hope you've been inspired. Check us out on social media via @ITProviderNet and visit us at www.itprovidernetwork.com for past episodes, show notes, videos, and more. And we hope you'll join Terry next time on the IT Provider Network.